Some of the arguments that you hear against becoming your own banker really stem from a lot of ignorance. Some of the common arguments I hear are you don't get a lot of cash values up front, it takes too long before your investment works. There's lots of cash value up front. You just have to know how to structure the policy properly, and that's where certain financial advisors do not know what they are doing, and that's why you need to talk to a qualified advisor. A lot of the financial gurus, especially the ones that are on television or the mainstream media or the internet or the newspapers, they like to tell you that you should buy term and invest the difference. When you compare that to becoming your own banker, it is not even a competition. Becoming your own banker blows that away. First of all, when you buy term, you're simply renting coverage. As you get older, it's going to cost you more and more to buy that term. With becoming your own banker, you're guaranteed a death benefit. Now there's the case of invest the difference, they say. Well, you've had in the first decade of the new millennium, you've had most baby boomers lose their money twice. They lost it first during the dot-com bubble, and they lost it again during the financial crash of 2008, and they're going to lose it again when the next bubble hits. If you had actually become your own banker, you would have reduced all your cost of borrowing, you would have guaranteed yourself a rate of return, you would have had all that cash value, and you would have been financially safe and secure. Nobody who's become their own banker and done it properly has ever complained about it. While people like myself and other people out there were predicting that there was a crash coming and telling people to get out of the markets, these people were telling people to get into the markets. Here's another argument that people have. They'll say you can do better if you invest that money. Well, once again, as people have pointed out, and I have pointed out, it is the order of returns that counts, not the magnitude. How about double dipping? Okay, you want to invest the rest? How about this? Borrow the money out of your banking system, out of your infinite banking system, and then go and pick up a secondary investment. The interest that you are paying yourself for buying the secondary investment is tax deductible against your other investment. So therefore, you're double dipping. And here's the best part. That interest that you are actually losing is actually going back to you because it comes back to you in the form of dividend interest. Why do you think you pay the interest? It's because if you're using the right insurance policy, that money is designed to come back to you and come back to you tax-free.